My name is Sharon Lewis, and this wanted to, welcome you to the new year. This webinar is actually geared for people who are worried about how much they're going to end up having to have to pay Uncle Sam in taxes, and how it's not too late to fix your tax situation before the new year begins. So let me just go over, this is a webinar for business owners and people making over $200,000 a year, because though that is actually the prime point for where taxes change and how we can actually help people make, savings on their income. My idea is, if we all have to pay taxes, nobody wants to pay anything more than their fair share. So my thing is like, what can we do to help people pay the least amount of taxes? I've been doing this for 24 years now, and I see where people who don't make a tax plan because they don't see the value of paying for that, and then they end up paying more and more for taxes every year because they didn't see that sitting down and spending, an hour, a couple times a year with a tax advisor could provide them with a strategy. So this webinar is for business owners who are making over, or for business owners and people making over $200,000 a year. If you're an S Corp, a sole proprietor, a high income business owner, we definitely want to talk to you about what we can do to help you keep more of your money. We want to talk to people who they know they're profitable, but they're unsure of what their profit really is going into tax season. And then they're also unsure about what they're going to be able to write off and deduct versus what they're going to have to be able to keep. If you don't fully trust your books, that is another thing that's very important for providing strategies, is having a good set of books to plan off of. And then the other thing is, we are not for people who are just startups. We're not for people who are on W-2 only. And we're definitely not for people who are DIY hunters, because I'm not going to tell you to just go and act the Augusta rule or just go and do something like that. We're looking to do comprehensive plans and comprehensive helping people provide strategies so that they can enact these things and then create a measurement again, for that, to see, is the return of investment actually there? Are we actually creating the wealth that you want to have within your business? Let's face it, none of us are working just because of the joy of it. We're working, in addition to the joy, we're also working for, the profit of it and for, bringing home money. If we were just working for the joy of it, we would probably be, running foundations and not actually owning a business. So the next question is, why does tax season feel so stressful for high income and business owners this time of year? And what so many people think is that if I just make more money, this wouldn't be so stressful. But more money doesn't actually equal clarity. More money just could mean that you could be paying more in taxes, or you see the money going into your account. And then if you're looking at your profit and loss statement and then your bank balance, there's a discrepancy there. The profit and loss says you made $120,000, but your bank balance says $20,000. And you're sitting there going, well, why do I have $120,000 worth of profit if it's not in my bank? Where did it go? And those are the things that business owners don't understand, because the clarity is not there on how those financial statements work and how to read them. Because bank balances is what people use to determine whether or not successful. But the bank balance is not what makes a business successful. What makes the business successful is a bunch of things on the balance sheet, as well as the profit and loss statement. And understanding how that works is imperative to you understanding how your business works. The other thing that we see a lot of people do is make decisions all year long without a plan. I was talking to a business owner the other day, and he decided to sell off a bunch of company vehicles and change some of the structure within his business. And he turned around to me and goes, well, I won't have to pay any taxes on those. And I'm like, yeah, you do. it depends on where you are to the depreciation. He goes, no, my controller told me we won't have to pay any taxes on them. And I sat there going, you're most likely going to pay taxes on it. And we'll give you an idea what those are as soon as you give us the documentation on the sale of the vehicles. But he's talking to somebody who doesn't do his taxes and coming up with ideas instead of running them past the people who actually do his taxes to say, this is what we want to do to help you pay lower taxes. He's making these arbitrary decisions without having the tax person, even though he's got a controller in his company. There's a misalignment, and that's a problem for us when we don't align with the controllers in the company because we're seeing things differently than they do. The thing is that taxes are changing annually. So a tax plan that's created right now might not be the same tax plan in the best advantage of somebody in the next year because everything is moving. It's a moving piece. The other thing that why tax season feels so stressful for business owners and for high income individuals is bookkeeping isn't finalized until it's too late. So too late means that when the books are finalized in January 31st or February, I can't make many strategy changes. Normally, strategy changes happen during the year and we implement them during the year. We have a little bit of planning time in January up to like the 15th of the month. And then after that, we can't help minimize the taxes. The only thing are is retirement contributions and maybe some adjustments with depreciation that can be done. But when the books are finalized, we can't, and it's after the fact, it makes it really hard to do that. The next thing is no one's connecting the dots. Is when you make an investment in something as a business owner or you change something as a business owner, you're not looking at how it actually falls under the tax returns to see what that actually triggers as far as different things, events in the reporting of the taxes. Taxes today have gotten so complex that it's a tool. It's gotten so complex that it's hard for people who aren't studying this stuff on a regular basis to make a decision on what to do, how to minimize the taxes. But the other thing in regards to this is that we live in a fantastic country where with tax planning, you can pay the least amount of taxes possible. If you are in Europe or other countries, they look at what your total income is, what your total expenses are, and then they say, this is what you owe us in taxes. They don't turn around and say, because the government does the taxes for you. And so they just send you a bill. We have the creativity in our country that our tax law is written so that we can plan, maybe this year is a good year for you to pay taxes because you have a lot of money coming in, but maybe next year is not going to be. Or maybe you want to push it down into the future where I need the money now because we're going to do this strategically, we're going to do this strategically, and we'll push off paying the taxes into, when we sell assets or when this product comes to market or whatever. And so the idea sometimes is to move the taxes, but unless you're connecting those dots to be able to do that, business owners miss those planning opportunities, and high wage earners miss those planning opportunities. So let's talk about what happens around the $200,000 mark, because $200,000 for us is a great playground for tax planning. What happens is at $200,000, deductions no longer move the needle in taxes. So if your income or your wages are below 150,000 or below 200,000, deductions, and we can look at different deductions to see if you do this, if you do that, it will help you minimize your taxes. But over $200,000, I can't tell you to just go take this deduction, it'll drop your taxes down, because it doesn't anymore. That threshold has changed, especially after COVID. They started at least moving that up, but it's changed to make it harder for people to pay less taxes once you reach that threshold, because you're considered high wage earner, even though we know that $200,000 today isn't what it was 10, 15 years ago. It's considered a high wage earner at this point in time. One of the other things that we see with businesses is that the structure matters more than the effort. We'll see a business owner who's making $200,000 paying maybe $180,000 in tax, or maybe 50,000 in taxes, where we can have another business owner who's making about that, paying $20,000. And that has only to do with structure and how things are placed within the business. The other thing that matters is timing. As I said, sometimes pushing things into the forward is better than paying taxes on it today. And that's one of the things that we're seeing with some of the tax cuts and the one big beautiful bill tax cuts that went out on July 4th. We're seeing that we're getting to do some more timing things that will move taxes into the future versus right now. Or some of those could actually minimize and completely remove some taxes based on some types of expenses and deductions. The other thing that happens at $200,000 is DIY mistakes get expensive fast. And we see this a lot of times where people come in and or they're going to the cheapest tax preparer they can, and that cheapest tax preparer didn't do any of the plannings or look at, if we make this change, it affects the tax that way. And so that's one of the things that we look at. One of them is the S corp. A lot of people will be a sole proprietor for a long period of time, and then when they come to us and we're like, let's convert your business into a different option, and they're like, oh, I didn't know that would change that much. And that's one of the big planning tools that we have that we can do things with. The other thing we're seeing is people not creating a tax plan will cost them money, because what tax plans do is they actually calculate out, if you implement this, this is what the projected savings could be. If you implement this, this is what the projected savings could be. Now, people sometimes only interact in, will do half those items because it's not convenient for them, the timing's not right, or they're saying, no, I want to pay some of those taxes today because this is coming up in the future. Those are things that we look at. And it's more of a holistic, we want to see the whole picture, not just do the taxes when people come in, because we want to know what's actually going on. Maybe right now you're making a lot of money in this, but something's going to change. And next year you're going to be making less money because you're building another product, or we've got R&D or different things like that we can use. Those are important things to consider, especially with the new one big beautiful bill that came out. Those are things that can be discussed and used as tools to help lower taxes. Common mistakes we see is, one is staying a sole proprietor too long. We actually look at this every year for our sole proprietors, and we'll turn around and tell them that we think you're going to need to change this year. Or we'll tell people, we don't want you to change for another year. We had one last year who said he wanted to change from a partnership to an S corp, and we pulled him back and said, no, you're not ready yet, and here's how it will cost you more money. And he goes, oh, okay. And so, it's in his favor. The other is paying yourself without a strategy. And we see this a lot with some of our business owners. They'll take a paycheck, but they also take distributions as they need money in their life without having a strategy for that money. Like they might say, I need to spend it on this, or I need to pay for that, or we're going to go here. But they're not looking at the strategy of how that affects their business or how it affects their retirement. Because that's part of the strategy, is figuring out, what do you want in retirement? Do you have enough in retirement? Can you, pay for some things differently, and creating that strategy? Like one strategy could be to pay for certain types of education expenses, but those are strategies that require, conversations and planning and understanding what those current tax rules are. The other thing that we see as a huge problem is messy or delayed bookkeeping. Give you an example. One of our clients, he has a bookkeeper. She's been doing great. Their bank decided to duplicate all of their transactions and recode everything into their books. So my bookkeeping team is familiar with this and went through and was able to correct that. But that ended up being a month and a half delay by getting, them figuring out that they couldn't fix it themselves. And it delayed our tax plan for the fourth quarter because we were missing some of that information. And this wasn't even anything he did. It was just his bank changed something in their portal system and it duplicated both of his business bank accounts. But that was a relatively simple fix. What if your books are a couple months behind? What if you're missing your books for 2025 and we've now started 2026? Those things can cripple a business when it comes to tax planning. I can't help business owners figure out how they're going to plan for taxes when I don't know what they're actually, their income is or what they could actually owe. And so that creates a disconnect. I can turn around and say, well, based on what you're telling me, make an estimated tax payment of, X number of dollars. But what are we running off your gross? I had somebody, in fact, that was a conversation I had with somebody in December. She says, I've made, $287,000 this year. I said, that's great. What are your expenses? I don't have my expenses. It's like, well, then I don't know how to give you a tax plan or even tell you what your fourth quarter estimated payment is. Take 10% of that and pay it into the IRS. That was pretty much what I had to tell her because I did not know what her income was going to be. And that was the best I could do. And if she didn't have $28,000 in December because she's contacting me then she's going to be short on her taxes again. And there's nothing I can do about that. The other thing is assuming the CPA or the EA can fix it later or the bookkeeper can fix it later. Fixing it later costs the business owner or costs you out of pocket. One of my clients who came to me last year, his CPA did not talk to him about any strategies, and he kept reaching out saying, we'll fix this, we'll fix this, we'll fix this. Well, the entire year has gone by, and finally they were able to get together. So not having that person available the entire year to help him make these decisions, it ended up costing him, out of pocket, and it's a year later, it's 2 years late for him to actually incorporate some of the changes that could have been done to change how his business is moving forward. The other thing is waiting until filing time to ask questions. During filing time, what happens in firms like ours that do taxes and advisory is that we're so busy doing returns that we don't have time to look at the big picture and to ask big picture questions. It's almost like when it's not, we're doing the after the fact of looking at it, but we don't have time to ask you what your plans are for the next year. Even if you ask those questions, we're not in that gear just yet because we're still thinking about this particular return and what that looks like to you. And sometimes taking a step back is really important. So at tax time, like I had somebody a couple of years ago already filed his taxes. He wanted to know about a Roth IRA. And I'm like, A, it's not going to affect you right now. And B, we should have done that, a while ago. In fact, that's one of the tax strategies that would be available to him is to do, what's called a backdoor Roth. It doesn't affect his taxes, but it allows him to put money aside, even though he already has a retirement plan through his business. He can do this backdoor Roth, but that requires the series of technical advice from a couple of different professionals to be able to do that. So that's why having the right professional and having time to ask those questions, and definitely not on September 15th, April 15th, or, October 15th. Those days are too late for you to ask those questions because, we're closing out your year and closing out your books at that point in time. All right. So here's a tax strategy. If you're still a sole proprietor and your after expenses is $200K, you are often overpaying on self-employment taxes. Frequently, it is a very simple fix, which is just an S Corp conversion, but it requires accurate books. We cannot make the determination that this is a really good move for you without actually seeing what those numbers look like and what the after-tax expenses are. And the timing of this matters completely. In fact, the last day I would do an S Corp conversion for 2025 is January 15th. And that means I have to have everything completed and ready to go. Because if I do it after that, you're paying penalties. And then the question becomes, is it worth you paying the penalties to save on that? and it creates a lot of stress. My staff doesn't like to work under stress because we're going to go into a stressful enough season. So we don't like to do these that late, but the timing really matters. The other thing is if you're going to do it, maybe you're going to do it next year. We want to do that before March 15th if possible. So there's a couple of windows of opportunity. But if you're not paying attention to the windows because you don't know about them and you're not talking to a tax advisor, that becomes a problem because you miss out on these opportunities. And the S corp conversion is not the only type of tax savings device that timing matters for. There are other savings devices where the timing is very important for us to do them. We want to do it by this date because this happens. We want to do it by this date because this happens. One client approached me, I think it was December 30th, and she wanted a tax plan and she needed to do a 401k for her business, and the financial advisors would not touch it. They said the best thing we can do is this type of investment. And the thing is that she knew that she was going to have a really big income month of December. There were just, the dominoes lined up just right for her. She knew this in October. She knew that things were going to come to fruition for this particular project. It was going to play out really well. It was going to be delivered, da da da. And she didn't reach out to me until December 30th. And there was 2 days to plan, and I was working on some other people's required steps that I needed to complete for their tax plan. So it made it a very stressful couple of days for us to get that data out for her. All right, so why DIY planning stops working? Some strategies interact with each other. So if you do one thing, it could trigger something else happen. So if you have a couple of different tiered strategies and those tiered strategies on DIY, one could actually wipe out another one. We've had this happen where a guy made the decision to make himself an S corporation. And in doing so, he ended up losing some of the tax credits that were available to him on his personal return. It's like, well, this probably shouldn't have been done without advice. He goes, well, all my friends told me to do this. The other one was we had a client go to a cocktail party and they told him to close out as this type of business and do it as that. The problem is when he closed business one owned all the assets of business, all the own assets. He never transferred those assets into business two. So he ended up having to file two tax returns, one for business one for business two, because he still had different things going into effect. And that was a DIY strategy. Cocktail hour friend said you should do this instead. And it ended up undoing all of his savings and cost him, two sets of corporate returns. And corporate returns aren't cheap. They are more expensive because fewer people can do them, and they're harder to do to make sure you have them right. There's extra tracking that has to happen. In the last 5 years, the IRS has put into place extra tracking that needs to happen on those corporate returns. And so it's important that those things, that's why they cost more, is because they're more complicated to do. The other thing that happens when you do DIY is that there's no testing. I can run through scenarios by saying, okay, if we do this, what does this actually look like for your tax return? And then we go, okay, this actually creates this. We don't want to do that because we actually have the software available. We have a kind of a pre-version of next year's software. It doesn't have all the bells and whistles to it, and the bells and whistles are constantly changing. And I mean by bells and whistles, I mean the tax laws are constantly changing. So but we know which ones are subject to change unless Congress springs something new on us in the middle of the year, which is typical. The other thing is that people who do these DIY things, they don't keep the required documentation, or they don't understand what tax tips they heard on TikTok will work for them and won't. I had a guy who came in and he goes, I want to do this, I want to do this, and I want to do that. He goes, I went to this guy's workshop and I said, you don't qualify for any of those. And then I had to go over with him why he didn't qualify for them, or if doing them could actually hurt him in the future based on how his business strategy set up. He goes, oh, and so it was an eye-opening thing. But the other thing is he didn't have any, documentation. If you come in to, the tax professional's office and say, well, I want to deduct this, and we don't have any support documentation, that's what the IRS looks like when they audit you, if you're selected for an audit. And they've gotten really good at mail audits lately, where they can just pick a couple of items from a tax return and send it off and say, send us the support documentation for this. And then we're going, where's the support documentation? And people are going, we don't have it. So when you do a plan with us, we actually have the documentation created ahead of time before we actually file the return, because we need to make sure our numbers are going to match and they're not going to change, because if we do it after the fact, it could change. Tax planning requires clean books because we use current data. In fact, we prefer to use live data if your accounting system connects to your bank account online and we can see what's really happening as it's going live. That helps us make a plan as to what's happening. As I gave you that example, the client that sold off the vehicles, we didn't have live data because the checks didn't go into the bank in a timely manner. Then he had loans to pay off. And because he owned like 8 company vehicles, and he just said, I sold a couple of the Kias. Well, when you own 5 Kias, I don't know which Kias it is. So which ones were they, so that we could match them up to make sure the right ones were being taken off the books so we can plan. So having current data, even if it's 30 days old, sometimes could be too late when you're getting towards the end of the year. The other thing is, everyone keeps saying to us, well, can't we just do AI for bookkeeping? And the problem with AI for bookkeeping is garbage in, garbage out. You need to program AI. I am all for AI. I see how it can help my industry. I, can see how it can help in other industries. I think AI can be a fantastic tool, but if it's not programmed correctly, we get garbage out. And that's what we see with a lot of people. One of the nonprofits I work with right now, according to their books that have been done by AI and the owner, is they've got a negative $87,000 bank balance. I don't know if Chase would actually let you operate with a negative $87,000 bank balance. I'm pretty sure they would stop, shut you down. But that's what Chase is saying is in their account because of how the AI has been programmed. So we can actually figure out what their numbers are, and their return is due pretty soon here, and I can't do anything about it. The other thing is that, look, when I gave you the example of the person who called me and said they made $287,000, I couldn't support an estimate strategy because all I could do is say, take 10% of what you made. That's just a gross number. She's going to be in the 20% bracket, but she's also going to have business expenses. But I don't know if her business expenses are 20% of that, 30% of that. Is it 50% of that? I know what the statistics are for her last year, but statistics is not really the best way to create tax estimates. And so if you have a clean set of books, I can look at it and say, okay, in April, through April, you made this amount of money. For the first quarter, you made this amount. Pay this in estimated taxes, because we see live numbers. The same thing happens in June when the next set of estimates come out. And having that really helps put down and narrow down what the taxes would be. Because wouldn't it be great for you to go to your tax appointment and find out you literally owe less than $1,000, or you're getting a little bit of money back? Because when you're high wage people, you're not normally getting a refund back. It's normally, how much am I going to have to pay? Or how much is my, how much have I overpaid, and can I roll that into the next year? That's what tax season really is for us, is that we're reconciling our income based against what our estimated tax is. And when we're doing that reconciliation, we're looking to see how accurate it is. But if it's not a reconciliation, if you're getting a surprise, then there was no tax plan in place. And then you're getting stuck with, oh my God, I got to come up with $10,000 right now, or oh my God, I got to come up with, $20,000, $30,000. And that happens to a lot of our business owners because they're not sitting down and looking every quarter, what is this going to look like for me? So now, if we're in this and you're really worried about what you're going to end up paying in taxes, there are still a few things we can do. Okay. And this is, the 12th hour, where, we're 10 minutes before midnight, just telling you right now, there is a few things that we can change. Number one is we can change entity elections. So if you are the wrong type of entity, it is important for us to look at it. If you're an S, if you're a sole proprietor or a partnership, this might be a good time to look at a different type of change for your business, but it will depend on some of the agreements in place and what your overall structure looks like and what next year is going to look like for you if you have any idea. Some industries are going into a recession. Some people are, if you're having a baby, this might not be a good year to make a change because you might be working less or you might be making some different types of changes. So you want to look at that. The other thing is your compensation structure. Are there things in the business that we can change how you pay yourself? The other thing is the timing of decisions. Maybe certain bonuses get paid, on the first of the year versus, in 2025. Or what are you planning as far as overall business meetings and education wise, maybe prepaying for some things, paying some things later. Those are different things that we can look at. And some of those only make a little bit of a difference, but some of them can actually make a significant difference. And it's rather surprising to see what type of difference those can make. The other thing too is the best time to start planning 2026 taxes is right now. We're in that year. What does that look like for you? What are your goals and ambitions for your company? What do you think, are you going to be hiring more staff? Are you going to be, moving to overseas operations? Are you integrating, more tech into your business? Where are you going to be spending your money, or how much are you going to be receiving, so that we can turn around and help make those decisions, so that we can say, okay, if you do this, because I look at tax planning as playing chess. If we make this move here and we make this move here, what's the end result? Which piece is going to be taken? Am I sacrificing a tax credit for a deduction? And so to me, it's how is that going to affect each of my clients? And what will that, what is the best benefit? Because sometimes we don't, we make decisions, especially as tax professionals, we make decisions based on the information given. And I can tell you how this blew up in my face, in my client's face one year. I didn't know he was getting ready to sell his business. He'd hired a consultant, and the consultant was doing great, teaching his general manager how to run the business without him. I thought he was just stepping back. He talked about selling it, and then he said, no, I've changed my mind. I'm not going to sell. Okay. Then he comes in and he says he wants to take Section 179 depreciation, which basically means expensing an item. So you bought two panel trucks, which were $35,000 a piece. So that's a $70,000 deduction in income. Sounds great, right? He sold the business 2 years later. That means we had to recapture everything. He told me he decided not to sell the business. Then he changed his mind. Well, evidently, he was doing a backdoor negotiation with a company that had been looking at it, and it took them a couple of years to move the money around. Had he told me this, all we did was shift the taxes over. But the problem is, in shifting those taxes over, he had a gain on the sale of the business and then a gain on the sale of the trucks. I would have rather have him paid a little bit of taxes today, or when he bought those vehicles, paid a little bit more in taxes. So he didn't have to pay as much when he sold the business. If we had talked about it, we could have at least discussed that. So planning right now for the next year is super important for the year that we're in, because then we can guide you throughout the year for those things. What can't be fixed after the fact? Number one is undocumented decisions. I see this a lot of times with like vehicle mileage, or we made a decision to do X, Y, and Z, but there's no meeting minutes, there's no notes, there's any of that, and it can't be fixed. The other thing that we see a lot is incorrectly reported income. When we see this a lot with people who are using a billing software or a quoting system, and a lot of times those things will duplicate data. When people aren't reconciling their bookkeeping each month, this ends up being a problem for them, because it overstates the income or understates the income, and then they're paying too much tax, or they could be paying too little tax. But the problem with that and paying too little tax is if you're caught, the penalties can be large. If it's a small amount of tax, the IRS isn't too hard on you. But if it's a large enough tax, they can charge you $5,000 penalty at to start with. So, keeping that in mind that you don't want your income to be off because it's been reported correctly. The other thing too is why give them anything more than their fair share? It's just not right. Poor records. Um, I see this a lot, especially people who might be running multiple entities, is they throw everything in one box and say it could be sorted out later. My firm doesn't sort information normally. I actually will bring in my teenage kids to sit and sort your data if you need it sorted that way. But poor records are the first thing to get lost in an audit. I can tell you right now, I have had a client who thought he kept great records, and the audit ended up, he came to me after he was elected for audit, and he even tried to handle the audit himself. But the way he had done his records, the IRS assessed him like $80,000 in taxes. And I was able to get it down to 20,000, but it was because his record keeping was really poor. We've actually come up with a new plan for him. He's still DIY records, but he's got a plan and he's got support documentation to verify everything we have going on, and it eliminates what happens with the IRS if there's a problem. And he has actually been selected for audit since coming to us. And all that's happened is he's gotten more money back than what we had originally put on the return because of some conservative decisions he made. And the IRS overrode those conservative decisions and gave him additional money, which we just giggled about, saying, well, we were being cautious. He said, I wanted you to be cautious because that's who he is as a person. So it was just interesting. The other thing is missed elections. If you file late or not on by a certain date, you could miss the ability to claim certain things. And so that is one of the things that we see a lot is a missed S Corp status election. One of them is one client of mine. I've been trying to convert his business from a C Corp to an S Corp for 3 years now. And that person had a stroke and is now in the hospital, and the business was forced into closure. But because they're 3 years behind on their books, we just got somebody to do their bookkeeping for them because they have a very specific industry. So I referred them out to a specific bookkeeping source for that. And because of that, they missed the S Corp election. And so they're going to be paying about $40,000 more a year in taxes for 3 years. On top of that, they're late. And so it just hurts. And these are the things that I can't fix. The right questions for you to ask now is, it's not just what can I deduct? It's instead, what's my smartest move when I file? Is it smart to deduct the vehicles, or is it smart to expense them over time? Is it smart to bring on a new person as an employee versus bringing them on as a contractor? And what are the different benefits to each? And do they qualify for that? Those are the things that we look at and want to talk about. Is it smarter to, put money into a retirement plan or leave the money in the business to do something within the future? Is it smart to set aside money for my profit or my tax account and have that money aligned so that I know it's available and I don't even have to think about that? That's what we sit there and talk to people about to make sure we have those decisions available, the answers available to those decisions right away. So there's two responsible paths forward. One is, if you are behind on your bookkeeping or your bookkeeping is not reliable, is get someone in there to do cleanup bookkeeping. We offer it. There are other services to do it. Do not just rely on AI to do your cleanup bookkeeping. It is not guaranteed that it is going to be correct. I did something with an AI software the other day and thought about it for 24 hours and turned around and logged back in and undid it. And I had the AI code all of these things and then said, no, I don't like how that is. I want to break that down. So this is me, somebody with 24 years of accounting experience, changing an AI made decision, a decision I made and relied on AI. And I had to go in and change it because I've been doing this long enough. And I just thought, I said, no, this needs to be handled this way because it more aligns with what the IRS is looking for. And that's the important thing for me, is making sure that when I make a decision for my client, I know what the IRS is looking for so that my client is not going to be, asked by the IRS to show up. And so I turned around and said, you know what, let's back that decision out. Again, 24 years of experience, and sometimes, pondering things for 24 hours is still the best guess. The other thing that I want to recommend to you is do tax planning. Do a forward looking strategy, especially if your income's going to be over $200,000. There are plenty of large things that we can do that will swing the needle so that you're paying less. If you're over $150,000, there's definitely things we can do to, help you, but you're not going to see as big of a swing as the people who are getting who are over the 200K. And we like to point that out to you, that that's where our sweet spot is once you're over that. If you're under that, it's a little not always as cost effective, but we can still give you some great ideas on doing that. But in order to have those ideas, it doesn't come during a tax appointment. It comes during a consultation and an advisory appointment, because they're handled differently and we put on different hats. We use completely different software, and we use completely different research tools. They might co-align with each other and we might use them in between, but they're different tools for looking for those paths forward. So keeping that in mind, the difference is between someone who's doing the after the fact and someone that's doing forward looking stuff. And after the fact requires a different mindset and, changing gears. What we don't do is we don't look for just loopholes. Okay. We don't do TikTok tricks, although you will see some of my videos on TikTok. We don't do TikTok tricks. There's no guessing, and we don't take aggressive positions. One of the softwares that we utilize takes a very aggressive position on something, and I will not present that to my clients right now because I don't see industry strong enough that the IRS is not going to, turn around and disallow this. I want to see a little bit more history on this new particular item. And so I won't take that position. I might talk to you about it if it's something that you might be interested in, but if you don't qualify for it, I'm not even going to present it to you. But I'm going to tell you right now, this is an aggressive position versus not, but I'm not going to guess. And I'm going to turn around and say, these are what the numbers could be based on what this information is here. So as I said, I actually have 24 years of experience. My firm's been around. This is my 21st year in business. July will start year 2022. I am an EA, but my bachelor's degree is in accounting. But I'm an EA. I also have a couple of people who are in the middle of working towards their CPA on my staff. We are a business-focused tax practitioners. We look at how we can help business owners save money on their taxes. That's one of the reasons why I said in the beginning of this class that we're not looking for people who are W-2 only. We're looking for people who are doing rental property, who have a Schedule C, who have some, investments, those types of things that we can actually help control the timing of some of those different payouts and create strategies based on that. And the next thing is that we look at clean books first. If your books aren't clean, we're going to ask you, can we clean them up or can you get someone to clean them up? Because me making a tax plan based on garbage is just going to be, a best guess. And that would be kind of like getting in the car in New York and saying, let's just drive west and we'll hit LA. And you could end up hitting, Ensenada, you could end up hitting, Washington, Seattle, you could end up in Canada or Alaska, just by heading west. That's not a clear enough decision for you or clear enough for you to actually get to your destination. That's what a tax plan is for. Because one of the things we ask is, where are you looking to be? What is your end goal? 5 years from now, 10 years from now, what does that look like? And maybe it's just 2 years from now. Your short-term goal is to grow this business and then sell it off, or grow this business and then work part-time, in this business. We don't know what it is, but we want to know so that we can make plans accordingly and help get that dream a reality for you. If any of this speaks to you, your next step should be to call and schedule a short qualification call. What we want to do is see if we're a good fit for you. If we're not a good fit, we're going to tell you. Maybe you're not, maybe you turn around and say, you know what, I don't like that they're not aggressive enough, or different things like that. But we want to see if we're a good fit for each other. Then we're going to determine whether or not you have to do a cleanup, or whether or not we're going to jump right into tax planning, which is appropriate for you. And as I said, if we're not the right fit, we're going to tell you. And I've pretty much gotten comfortable with telling people that you're not a right fit for us. And I'll even refer you out to somebody if I'm not the right fit. I've done that in the past. So stop guessing before you file. In fact, what I say to people is, if you plan your vacation every year, why are you not planning your taxes? Use this tax season wisely so you can plan your taxes for 2025 with what little bit of window we have left, but also for 2026. This way, there's no surprise. My name is Sharon Lewis. This is my contact information. The easiest way to actually reach me is through the admin. Admins will forward over emails to me promptly. You can call and set up appointment, or actually go to the Calendly link right there. Our job is to turn tax stress into tax success. Before somebody e-files you, we really pride ourselves in making sure that business owners and people pay the least amount of taxes possible, based on the information that you give to us and based on our years of knowledge asking the right questions. So does anybody have any questions that I can answer for you today? I hope I didn't cover this all too fast, because I know this is a lot of information. All right, let me just look in the chat here. Nope, there's no questions in chat. Well, I appreciate you attending today. Thank you very much for being here. You'll probably get a survey in the email. If you can just respond to the survey whether or not you thought this was helpful, that would be really good, as we try to prepare for more good content on the internet and available to the people who sign up for it. Thank you very much for being here today, and have a blessed and prosperous 2026.